Hello everyone and welcome to this week's edition of Bond Vigilantes TV. It's our last edition for the year, and for today I'm delighted to be joined by Ben Lord, who's shining brightly even more than before. Good morning, Ben.
Good morning.
Ben is here to give us his outlook for 2018. So Ben, when you look at bond market performance, despite what everyone said at the end of last year, it's still been a good year overall. Predicated on relatively good growth globally and low levels of inflation that have been positive for risk assets. What's your view for 2018? Is that going to continue?
I think it will continue. I think we're going to be in a good growth environment with manageable inflation, although I do think that all the pieces are in place to see inflation start to rise. And it's going to be driven out of the US. Globally, we're also going to see the pass-through of higher energy prices. Oil has been on an upward path in the last few months for various reasons. But then in the US, wages are going to start to head in the right direction. They're already at 2.5% year-on-year average hourly earnings. And you've got a variety of transient factors that are coming out of the numbers. So I think inflation is going to go higher, particularly from sort of March, April of 2018, driven by the US, supported by oil. And growth is going to be solid. I think the risks to that outlook, which is very consensus, are to the upside. I think there's a chance that we're in something of an industrial boom where companies are finally investing in their plants and equipment to meet this pickup in aggregate demand, global aggregate demand that's happening in a very synchronized manner. And input prices are rising, and if companies can't meet their new orders, then they're going to increase prices. So I think that the risks to the growth outlook, as I see it, are to the upside for 2018. Okay,
great. So a positive tone globally. Would you apply that judgment to the UK as well? The Bank of England seems to be stuck between a rock and a hard place. The OBR just reduced their growth forecast. Inflation remains sticky. What would you do today if you were Mark Carney?
Yeah, the UK is not as strong as other areas, particularly Europe and the US at this point in time. The consumer outlook isn't as solid, higher levels of indebtedness, negative real earnings growth, and a variable rate mortgage market, which means we probably can't take the levels of interest rate hikes in a cycle that you've seen the US take so far, given they've got a 30-year fixed rate mortgage market. The differences between those are huge. And we don't have a manufacturing sector that's sadly big enough really to pick the rest of the economy out from its malaise that's being brought on by this uncertainty. Uncertainty is bad for investment, and we are seeing that in the data, particularly that the Bank of England agents report. So you can see it and see the early signs already.
So you don't see many hikes over the next few weeks and months?
No, not many, if any.
Okay, great. Turning over to credit now. As I mentioned, spreads have continued to grind tighter. Now triple Bs are trading around 100 to 150 basis points in credit. What's your view on credit? Where do you see value today?
I mean, we're always structurally overcompensated for a reasonable level of defaults. So do I see a significant turn in the default cycle in 2018? Probably not. You have the ECB is still buying corporate bonds and government bonds. The Bank of Japan is still pumping money into the system at a decent clip. So I don't see any reason why, given where we are in the credit cycle, particularly in Europe, that you would expect to see a big sea change in default levels in 2018. And as a result, I still see value. But you know, you've got to look for sectors that will do well out of a reflation or an improving growth and increasing inflation environment. And frankly, that probably still points one towards financials as a decent place to go. But no, still reasonably positive. Not as long credit as I was at the beginning of 2016 when spreads were cheap, but by no means calling the top and wholesale selling credit risk.
Okay, great. And my final question is, given the time of the year, if you had one wish for markets next year, what would that wish be?
I think it would be for the hard economic data to catch up with the survey data. Survey data, almost globally, looks very, very strong. and has been meaningfully higher than the hard data that we're seeing come in. So if we get a catch-up, if we get a convergence between those two in a bullish direction, you're going to get higher yields, you're going to get steeper curves, and higher break-evens, and 2018 will be a happy one in that environment.
Thanks, Ben. Thanks for being here.
Thanks.
In terms of what to watch out for next week, it is a relatively busy week, still especially in Asia, for example, where we have the China annual conference today and tomorrow. We have a Bank of Japan meeting on Thursday. And of course, in the US, it's the make or break week for US tax reform with Congress ratifying potentially over the next few days the latest version of the bill before it gets sent to Trump before Christmas to get passed into law. So thanks for your loyalty this year. Have a great festive season and speak to you all next year. Merry Christmas.